Hi, this is Sam, a dealer from CFD Department, and welcome to this week's market commentary. U.S. stocks started on Wednesday positioning the Dow Jones Industrials for their best first session of a new year since 2009, as Wall Street welcomed an 11th-hour deal to avoid steep spending cuts and tax hikes that is fiscal cliff. Most of the major indices started 2013 in a rally mode, with Dow Jones climbing 13,412.55, up by 2.35%. Hang Seng up to 23,311.98 points by 2.89%, and STI closing at 3201.74, up by 1.09%. The compromise deal approved by Congress largely blocked tax hikes for all but the wealthiest 1 to 2% of U.S. households, providing a momentary reprieve from a lengthy standoff over how to avoid more than $600 billion in tax hikes and spending cuts, viewed as likely to push the economy back into recession. The measure bypassed much of the immediate trauma posed by the fiscal cliff and marked only one piece towards cutting the federal deficit, with a February battle looming over increasing the $16.4 trillion debt ceiling and settling the spending cuts. So the next focus will certainly be on what happens in the next 2 months in terms of addressing the spending cuts of $110 billion and the need to raise the debt ceiling and the effect all this has on GDP growth rates. Growth of the world economy has been weaker than expected, with UN cutting down expectation for 2013 to 1.3%. But even if this pace continues, it would be manageable to overcome continued job and economic crisis in the long run if sustained. Worries about Euro sovereign debt have eased significantly as well, at least in the ability of the crisis to shock US or Asian investors. The continent's problems are far from over, given the unsustainable borrowing costs of several Eurozone members, but the whiplash-inducing anxiety on these shores is gone for now. Concerns about slowing economic growth in emerging markets, in particular China, also have begun to dissipate, with recent manufacturing data suggesting that there still is a potential for growth to happen and drive the economy on a positive direction. There's plenty of liquidity in the financial system, and the Federal Reserve and G4 central banks are committed to keeping interest rates low. We should keep the economy out of the serious trouble. Last month, the Fed confirmed its low-rate stance yet again, saying it will buy up $85 billion of mortgage-backed securities and Treasury debt per month to drive down long-term rates. And with the market sentiment and consumer confidence at its high since crisis, we remain constructive on equities overall, with an expectation of upside risk for 2013, continuing their secular bull market trend this year. Sectors to look ahead in 2013 include technology and financials. A resuscitation of growth in China and elsewhere suggests that crude oil, gas, and coal prices may rise, which means the energy sector, last year's second worst performer, could turn up into a winner this year. That's all for this week. Thank you for watching.